What's up guys, welcome back to InvestingPH. As I've mentioned in one of my videos, usually the Philippine market start off strong at the start of the year, then goes down again usually after March. This has been the cycle ever since the pandemic years. You can search it on Google, where you see a lot of analysts predict the market will go up this year, or the market will break past 8,000. These projections, I don't listen to it. No one can predict the market. I just do what I normally do. Research a company, determine if it's strong financially, and then compute my buy price for it. If it passes everything, then it goes to my watch list, and I invest whenever the company goes below my buy price. If way beyond it, I'd go to the next stock. I want to make my strategy as passive as possible, like what the index is doing. So for others, they're sad when the market and their investments are going down. For me, I'm very happy as I get to buy more stocks at a discount. And the best part of it, with the stock price going down, I can get a higher dividend because I'm not looking for short-term gains. I want to bulk my portfolio. I want to put in more and more money while the market is down, because for me, this is the best time to invest while prices are down. This is where I get good deals and better dividends. So in the long run, when the market does rise again, I already have a large enough money invested. Unlike when markets are rising so fast, yes, you'd be happy that you feel like an expert, but how much have you invested? Is it life-changing? So for someone who relies solely on his monthly income for his investment, this is a big advantage for me. So for this video, I want to share the 4 stocks I'm buying right now that the market is down yet again. First, AREIT. I was waiting for the stock to go down to my buy price, and now it did. I am continuously buying for the past weeks. AREIT is the real estate investment trust of Ayala Land, which is the second largest property firm in the Philippines. For 2023, total revenues increased 41%, now 7.14 billion, EBITDA 39%, and net income climbed 43%. Occupancy stands at 97%, gross leasable area climbed 36%. So for 2023, it was another great year for them. If you look at previous years, since 2019, they've grown their revenue and EBITDA consistently. Now this is important as you are investing in REITs. You have to know how the company is doing in terms of earnings, as their dividends are tied up to it. The more it grows, the higher dividends we can get. By the way, this table was provided by my broker DRAGONFI. How great is that? I didn't need to build one myself, as it is already presented neatly. They also have research for AREIT and a target price, which can guide you even if you're a veteran investor or just starting. If you want to try it out, go make an account using my referral code below. As mentioned a while ago, the more they earn, the higher the dividends. And so since 2020, AREIT has increased its dividend payout, and asset infusion is consistent as well. With this, the higher chance their earnings will climb as well. Right now, its dividend yield is 6.5%. For debts, it's well managed, with a debt to equity of only 0.11, meaning for every 1 peso of equity, they only have 0.11 peso of debt. For price valuation, price to earnings is 13.94 and price to book is only 0.95. As you can see, both valuations have dropped significantly as their stock price went down from a high of 50 pesos per share now to less than 34 pesos. For my intrinsic value computation, I used a dividend discount model for it, which I got 45.32, and I only used a 20% margin of safety as I used a very conservative dividend growth rate for it, which gives me a buy price of 36.25. Again, never use your buy price as a sole indicator when buying a stock. It has to first pass through your checklist, check how its valuations are compared to its peers, and if it's worth buying at this price range for the dividends you are getting. The next one is Pure Gold. Like Warren Buffett said, buy the stocks you know very well. Well, ever since I was a kid, we go to Pure Gold for groceries, and now sometimes SNR. Anyway, if you didn't know, Pure Gold also owns SNR, but I didn't invest in Pure Gold for that sole reason. When I researched the company, well, its financials didn't fail me. Before that, a quick preview of their stores. In 2023, Pure Gold had over 558 stores. 316 of it are hypermarkets, 98 supermarkets, 67 extras, 24 SNR, and 53 SNR quick service restaurants. These are the SNR stores you see sometimes in malls. These are all scattered throughout the Philippines. In the third quarter of 2023, they opened 30 Pure Gold stores, 2 SNR, and 2 quick service restaurants. Revenue had been increasing steadily over the years, though their earnings in 2023 decreased by about 9%. Equity also increases consistently every year, and debts are managed very well. Debt to equity is only 0.94. For its dividends in 2022, they've made a new dividend policy to declare as dividends at least 30% of its income, which is why their dividends have grown so well these past years. And right now with its price, its yield sits at 4%, which is not bad even for a dividend investor. For price valuation, price to earnings is only trading 8 times its earnings, and price to book is 0.8. This means we are buying their equity at a discount, only 0.8 peso for 1 peso of their equity. As for my buy price, my computed intrinsic value is 38.97. With a 30% margin of safety, my buy price is 27.28. This is a big drop from my previous computation of pure gold, as the market had been pricing pure gold for such a low price for a couple of years now, which made the 5-year average PE lower, and with its earnings dropping, this also contributed a bit to the lower buy price since the average projected growth for it had decreased. By the way, if you're curious as to where I get the graphs for the earnings, PE ratio, price to book, it is from Simply Wall Street. If you haven't tried it out, then you should definitely do so right now. They have a forever free basic plan, and you can already get a ton from it. The way they present the data is simple and can easily be understood even if you're a beginner investor. However, you're only limited to a number of stocks for the basic plan. So if you do want to avail of their paid plan, where you can have access to their portfolio tracker and a lot more tools, sign up using my link and you can get up to 40% discount. So try out Simply Wall Street. Third, Philinvestland or FLI. Well, I know this company has had it quite rough these past years and hasn't yet recovered past its pre-pandemic revenue and net earnings. In 2023, its revenue had increased 13% and net income to 30.10%. Still, this isn't yet enough to even come close to its 2019 earnings. Its portfolio consists of mid-rise buildings, which are the largest at 55%, house and lot 27%, high-rise building 15%, and non-core 3%. This is spread throughout the Philippines, over 22 provinces, and 55 cities. Now, though its revenue and earnings haven't yet recovered, its equity is consistently growing, and as to how they manage their debt to equity is only 1.16. That's why I'm not at all concerned about my investment in this company, as they are still expanding their business and debts aren't a concern. And with the economy recovering, I think their business will eventually as well. And as I'm waiting for them to recover, I'm getting paid quite well. Right now its yield is 5.2%, but the company just announced its dividend payout with its earnings higher last year. They will pay 0.05 pesos per share, which for the current price sits at 7.24%. Since 2022, they are paying 30% of their net income. As for its price valuation, PE ratio is only 4.4 and price to book is at a very low 0.2. So we are getting a huge discount, and for my computed intrinsic value is 1.07, and with a 30% margin of safety, my buy price is at 0.75, the same as my computation for pure gold. Since the average price to earnings of the company had been low for the past years, this made my computation even lower. By the way, if you're wondering when do I update my computation, I only do it once a year, usually after the annual earnings have been released. Lastly, Megaworld. Oh come on, this again. Yes, how could I let the opportunity of buying it at an even cheaper price? Sometimes this is what I don't get with the market. Back pre-pandemic, they priced Megaworld at 6.14, wherein its net earnings were 17.37 billion. Now in 2023, it has 17.34 billion and a higher revenue of 64 billion compared to 61 billion in 2019. It is priced at 1.82. Well, of course, I know the market doesn't evaluate it evenly with how its financials are doing, because I've seen companies with negative earnings priced so high. That was the year I saw a lot of expert telco investors commenting on my videos. I wonder what stock that is. Anyway, Megaworld has now reached its pre-pandemic earnings and its revenue has already gone past it. Equity was left unfazed, even in the pandemic, continuously growing every year, and its debts are managed very well. Their debt to equity is only 0.69. For its dividends, with its price right now, its dividend yield is 3.8%, and with how Megaworld paid its dividends, I'm sure it will be higher this year as their earnings have grown last year. This is why even though Megaworld is one of the biggest losers in my portfolio, I'm not at all concerned and I'm even buying even more. With a good dividend yield, I'm getting paid while waiting, and the company is continuously growing. Its businesses are spread throughout the Philippines, real estate sales are recovering, New projects are being launched, mall businesses have recovered, and occupancy rate is higher, now at 93%, though their office occupancy rate decreased to 88% versus 92% in 2022, rental income has still gone up. Hotels and resorts also went up big time, with occupancy rate increasing to 67%. This is higher compared to pre-pandemic, and more coming up this 2024. So with a good business at hand, even when the price goes down, I'm not concerned and will continue buying it. I'd be concerned if the company I'm holding is like this. Then I'd really be concerned and will actually sell a company with these financials. For its price valuation, PE ratio is 3.1 and price to book at 0.2. As for my buy price, I didn't change it to be more conservative as my new computation is higher. My computed intrinsic value is 4.57 with a 30% margin of safety. My buy below price is 3.2. With that, this ends this video. I hope you've learned something, and if it did and still haven't clicked the like button, be sure to do so before leaving. And if you haven't tried DRAGONFI and Simply Wall Street, then use my link below and sign up. Level up your investing journey. Thank you and see you in the next video.